take the discussion on RBI policy and what to expect. What are the key monitorables there forward with Abheek Barua, Chief Economist at HDFC Bank, joining us now. Abheek, good morning. Thank you very much for your time. While there is almost a consensus on the street and in the industry about the any possible rate action, most believe there won't be any. But this time round, the way global macros are shaping up in last few weeks and months, people are eagerly awaiting the stance which RBI governor actually takes in this changed environment. What are one or two most important things you would watch out for as far as the governor commentary is concerned, especially on liquidity and growth?
Yes, right. No, I think you're spot on when you sort of mention liquidity, because I think the market's focus is now on the liquidity strategy or the liquidity stance of the RBI. As you know, there is a lot of money coming in because the ICRR, sort of brief ICRR regime comes to an end on the 7th of October, and consequently, you will see liquidity come back to the market after remaining very tight, and the advanced tax outflows,
We seem to have snapped that line. Just going to get back to Abheek in just a second from now. In fact, I just want to take it across to Ankur as well. He's at the RBI headquarters. Let's try and understand what is the expectation from him. We'll do that in just a bit. But it pretty much is the status quo when it comes to at least the rate action. It seems that the Reserve Bank or the MPC will choose to keep the repo rates unchanged, and the stance is going to be a withdrawal of accommodation. That is what the ET Now poll is penciling in. We should quickly get Ankur mic'd up before we actually hit the RBI address from the governor himself. We're expecting a hawkish pause. The view on global central bank action and what the RBI's reading of that has been is going to be very critical, like Ajay also flagged out right now. I think Abheek is back, and we will get it back to Abheek. Abheek, we lost you there, but please finish your point.
Right. No, I was just saying that the focus will be on liquidity and whether the RBI continues with this very tight money regime that is prevailed for the last few weeks, a couple of months actually. And I think the market is focused on that. In terms of the broad monetary policy stance, withdrawal of accommodation has become sort of the default stance, and I think it will continue. No rate action. But I think we will, as your colleague said, that the biggest, the dominant feature of the sort of the global scenario that the RBI is looking at is uncertainty, and extremely elevated uncertainty, particularly in the bond markets. So I think it will be a vigilant policy, not neither ultra hawkish, not terribly dovish, but talking about the various things that the RBI will have to navigate in terms of the global scenario, the extreme data dependence on what is happening to monetary policy elsewhere, and that does influence our policy. And just provide some comfort to the market that things are under control, and also acknowledge the fact that the inflation spike that happened because of vegetable prices has been transitory. So we are expecting a sharp drop in inflation in September. Maybe they acknowledge that. So as I said, sort of Goldilocks, neither too hot, neither too cold, but the Arjuna's eye remains, firmly on inflation. But I would say there is another eye which is focused on uncertainty and the impact of uncertainty on asset markets, particularly the markets that the RBI is concerned with, which is the bond and the FX markets.
Abheek, also I want to understand, between last policy and this, which one is happening today,
right?
The hawkishness which we are talking about now actually came on the table last policy, when he did mention in the commentary that they would monitor the data very closely because possible rate action would depend on it. So which means rate action, the possibilities came on the table. What exactly has changed in the global scenario that most central banks are forced to become more vigilant with a slight shade of caution?
No, I think what has happened is the runaway increase in the dollar and the rise in bond yields in the US which has led to a bond market rout. And so this has an impact on capital inflows and outflows. And with elevated yields in the US, the carry has simply disappeared. So both from the equity and the bond markets, there is, a situation where investors would want to pull out and put money in the US. And of course, there is this uncertainty factor playing out, which is causing a risk off. So, to the extent and that central banks look at currency management, and in our case, we sort of do emphasize currency management quite a bit, trying to keep it within a reasonable band. This is bad news. So we'll have to kind of so what has changed is is what has happened to the U.S. economy, the uncertainty about whether there'll be another rate hike, and so forth, and the way the markets have kind of priced it in ahead of the actual event. And that's something that has kind of rattled markets across the world. And for the RBI, two important variables are at stake here, if you like. The local bond deals, which are correlated to some extent with the US bond deals, and of course the rupee. So I think apart from the usual sort of vigilance on inflation, there has to be scope and some sensitization to the possibility of action to counter the impact of very sharp capital outflows, which could impinge on the rupee and then again sort of set off its own inflation cycle. The other thing, of course, is of course oil prices, which kind of went up very, very sharply beyond expectations for most, but it's sort of come down a little, hopefully. But again, it sort of just compounds the uncertainty, leading to a safe haven flight